I'm David Paul. I've got a checkered background. I've got a degree in engineering. I've got an MSc in metallurgy. I've got a PhD in mathematics, all of which is largely useless in taking money out of markets regularly and consistently, I assure you. I think the thing that I've done in my life that's helped me most in markets is in my youth I was an officer in the Royal Marines. And that's given me a level of confidence and discipline that I've built upon for a very, very long time. So what I'm going to talk about today is what I've been doing myself. I've been talking about stock markets for a very, very long time, and I largely only talk about what I do myself. And that's meant that most of the talks have gone well because it doesn't matter what questions I get. I understand every last little nook and cranny of the investment because I've been there. So what I'm going to talk about this afternoon, I'm going to talk about the most conservative VectorVest trading plan. We refer to it as worry-free investing. Today I've talked about growth stocks earlier on this morning. I've talked about swing trading in the little room next door, and I think that my rugby coach, I went to South Africa in 1981 to play professional rugby, and my rugby coach down there always used to shout at us, "Let the ball do the work." In this particular strategy, what we're going to try and do is that we're going to try and find some big trends and forget about the noise and let the ball do the work, let the share do the work itself. Now, in swing trading, we're largely looking at the same shares, except that we're trying to pull high momentum moves out of the move. Here, we're going to do our best to get the hell out of the way and let the ball do the work. That itself, of course, means that there will be areas where the share pulls back because they don't go up in a straight line. They go up in a series of steps. And it probably means that this methodology is less amenable to leverage or to use spread bets. Because when the share's going your way, spread bets are wonderful. And when it's pulling back a little bit before it goes your way again, that's quite miserable if you've got leverage. And if you don't understand the emotional impact of that, then open up a spread betting account and just have a go. You'll find out very, very quickly that when it's not going your way, that causes a great deal of angst. Okay, so let's move on. I haven't got that much time and a lot to talk about. The first thing I've got to put up is the VectorVest disclaimer. I think we're the only, and I speak under correction, that we're the only company that sells stock market education and stock market software in the United Kingdom that's regulated by the FCA. And although I'm qualified to give investment advice, I can't do so because I haven't sat down with you and done that long and detailed fact find that your financial advisor will have done with you. I'm allowed to talk about those shares that I hold myself, but I have to make it very clear that although those shares are suitable for me, they may not be suitable for you. Every Monday afternoon, I run a series of webcasts where I actually talk about what I'm doing myself. And everybody who's involved in that sees all the good trades and all the bad trades and all the mistakes that I make. Hopefully, we all learn something from those mistakes. So they see everything, warts and all. We don't want to be married to the thing. In this particular methodology, I want to get us to a point where we can actually keep our portfolio under control in a few minutes an evening. So not sitting watching screens all day. Who watches screens all day here? Must be a few. I can't manage it any more than a couple of hours these days. And I do trade the S&P reasonably aggressively when I feel like it in the afternoon, in the American morning. So this is how we're going to make our money, folks. The first one's relatively obvious. We want to find shares that are going to rise in value. We want to find shares that are going to pay a dividend. Laser doesn't work. And hopefully, we'll have the discipline to add that dividend into the mix. Okay? Don't blow the dividends. If you can keep your hands off them. Adding the dividends into the mix has a huge impact on the capital growth. And you can actually work that out in a simple little Excel spreadsheet. You will not believe how fast it grows if you add the dividends into the mix. Now, those of you that want to try this in North America, in the US, then in the US, the options market is highly liquid at the retail level. In the UK, the options market is essentially illiquid, impossible at the retail level, i.e. us. But if you do this in the US, by writing the most conservative option strategy, which is called covered calls, you can probably make 6 or 7% a year relatively easily. And you can add that into the mix as well. In the UK, we're going to make our money from capital appreciation and dividends. The options market just simply doesn't exist. Now, that wasn't the case 20 years ago. There used to be a very efficient and well-traded options market at Life, the London International Financial Futures Exchange, but when Life was sold, that largely disappeared. So, what I'm going to talk about is the VectorVest system of analyzing shares. I'm going to talk about market timing. We believe that there's a safe time to be in the market and a really awful time to be in the stock market. And when the market is rising, I want to be pretty much fully invested. When the general market is falling, I want to be careful. I don't want to be buying any more stocks. I want to be watching stop losses carefully. And I want maybe to be raising some cash in my laggards. If a share has done absolutely nothing on the way up, then there's not much possibility of it doing anything when the general market is falling. So raise some cash for the next buy signal. Awful to have a buy signal and you've got no ammunition. So that's what I'm going to try and talk about. So let's work through the first bit. The founder of VectorVest, 30 years old, and the founder of VectorVest, Dr. Bart DeLido, is largely a fundamental analyst, whereas I would class myself as largely a technical analyst. He's put together a valuation algorithm that looks at earnings, inflation, and interest rates and puts a value to every stock on the London stock market. Now, on our stand outside, we have a little green book, and in chapter 3 of that green book, he goes through the mathematics of the valuation algorithm. So if you're of an analytical background, you can go through that, get your pencil out, and work through that. It's pretty much the same as the valuation algorithm that was proposed by Ben Graham, who's Warren Buffett's mentor, in a book called The Intelligent Investor. Who's read The Intelligent Investor here? A few of us. Did you enjoy it, sir? Good book, yes? Very nice, especially the newer versions. I have them all, but an exceptionally good book, that's for sure. And I'll quote Ben Graham on a few occasions before I'm finished. Okay? And I could digress for hours into it, but I'll spare you that. All right? So we put a value to every share in the stock market every single day. When I was a youngster, my grandfather was a farmer in the north of England. And he always used to tell us, the only way to make money in anything is to find the value of something and pay less for it. When I read The Intelligent Investor, I got to the end of the book. And in the last chapter, Ben Graham, Warren Buffett's mentor, says, just wait until Mr. Market does something stupid, and then you can get the share cheap. So essentially, Ben Graham and my dear granddad were saying the same thing. The only thing that I'm sure of, James, is that my granddad had never read The Intelligent Investor. He was quite what I would call a rough diamond farmer from the north of England. We believe that every investor should know, what's the stock really worth? How safe is the earnings stream? And because this is a worry-free type seminar, I'm going to emphasize this afternoon the safety and the predictability of the earnings stream. And we only want to look at stocks, ladies and gentlemen, that have got a proven track record of making money and all the financial numbers are getting better. This is a hands-off strategy. We don't want surprises. And then finally, some idea about the trend of the share. Now, a very important number is relative value. And relative value is, as the slide says, is an indicator of the long-term price appreciation potential. Now, for long-term, read 3 years. And relative value forecasts the share price increase over 3 years in relation to what a AAA corporate bond will pay in the same period. Now, a AAA corporate bond is Dr. Toledo's definition of a risk-free investment. Here's how we do this. We forecast the earnings of every share in the London stock market for the next 3 years. 1 year out, 2 years out, 3 years out. We do that by extrapolating from financial statements, and we've been doing it for 30 years. And secondly, by buying an earnings forecast from the world's top provider of such a company called FactSet. So we've got a number for the profits of the company next year, the year after that, the year after that. We make the following assumption. We assume that those earnings will be discounted into the price at some time over those 3 years, not when within the picture, just that timing window of 3 years. We calculate a projected price, and we subtract the price today to get the upside, and we divide the upside by what a corporate bond will pay in the same period. Now, if your share has got a relative value of less than 1, that's saying that we believe the share has a high probability of underperforming what a bond will pay. Now, those of you that understand the pecking order will know that the bondholders get paid a mile ahead of the common shareholders. But I think, I'm not an accountant, but I think the bondholders get paid just after HMRC in the payout line. So, if the RV is less than 1, you would be taking a risk in something as intrinsically risky as a share for less than you can get from a pretty much guaranteed return from a corporate bond. RV greater than 1 is not bad. And ladies and gentlemen, from my testing, from our research department in North Carolina's testing, and by our customers' testing, especially one customer down in the Guilford who's a consummate tester, we've proven that we need an RV, our relative value, of greater than 1.25 to satisfy the capital gain requirement from our portfolio. So folks, the first parameter that I'm going to look for in my worry-free exploration is the share must have a relative value of greater than 1.25. That's the first hard parameter. Now, the second major VectorVest metric is relative safety. Now, relative safety is an exact number. In relative value, we're predicting the future. And as Mark Twain so beautifully said, the future is a very slippery commodity. Relative safety, we're looking at the cold, hard numbers from the balance sheet, the income statement, the cash flow statement. We're looking at dividends, dividend growth, dividend safety. We're looking at free cash flow over the last 5 or 6 years. We're looking at margins, all sorts of things, all sucked in, and we spit out one number on a scale between 0 and 2, which represents the relative safety of the share. Above 1 is fair, above 1.25 is excellent, and when you get up to about 1.3 plus, this is a company that's making money, and all those financial ratios are getting better. Now, for our worry-free, hands-off, let the ball do the work trading, I'm looking for shares with the highest relative safety on the London stock market. So the first parameter is that I want a relative value of greater than 1.25, and the second parameter is I want a relative safety above 1.3. And ladies and gentlemen, what we're after is that I want to try and find shares on the London stock market that are growing earnings strongly and have a proven track record of safety of growing those earnings strongly. And these are some very, very special stocks. There's not that many of them on the London market that have got a foot in both camps. Strong growth, safe growth. Okay, that's what I'm looking for. On the American market, there's an awful lot more of them. But on the London market, there's enough to be going on with. And since I came back from South Africa, I had some fairly flashy footwork to do to get back into the property market, I assure you. When I went to South Africa, the rand was, in fact, pretty much the same as the pound. And when I came back, it was 19 to 1. So selling my little place in Cape Town didn't cut a great deal of ice in the local market. So these shares have been very, very good to me. I'm, in fact, thinking of moving out of the capital at the moment, somewhere in Wiltshire. And I need to do another bit of fairly flashy footwork to get that one as well. This measures the short-term trend of the market. And then as a default, and if you go to our stand outside, you'll see that all the shares on the London market are rated by VST. Now, for the first two talks today, growth stocks and swing trading, that VST sort is the best. But for this particular talk, I'm going to, in fact, sort shares by relative safety to bring the safest to the top of the pile, because in worry-free trading, we don't want any surprises. We want to find the UK's safest shares. So the talk that I did at 10:15 or whatever it was next door on growth stocks, there's slightly more risk in that particular approach. And the other talk that I did in swing trading, there's more risk in that particular approach. In this particular approach this afternoon, I'm putting to the top of the list of considerations the safety and predictability of the earnings stream, so that we can play golf and chill and let the ball do the work. We calculate a stop loss for every share in the market every single day. Those of you that have been at this for a while will know that stop loss placement is key to your survival, because the chaps in the city will do their best to get their best clients in where you got stopped out. Has anybody ever found that? You get stopped out and the bloody thing turns and goes to heaven. If your stop loss is any way predictable, they'll nail you. I remember, sir, the man here with his arms folded. I remember a young fella just like you said to me, I can't believe anybody's out to get my money. Well, they are. Okay, they are, because I assure you that I remember once upon a time being in a trading floor where they'd filled Aberdeen Asset Management at the high of the day. This is years ago. Martin Gilbert called them from Scotland and gave that trader a hell of a time because he'd filled somebody at the high of the day. He hadn't got them in at the low of the day. To get them in at the low of the day, it's quite easy to bring the market down a bit. If your stop loss is anywhere close, you get nailed. Come out to the stand, you'll see a little company where there was a stop running exercise last week. Market went down on an intraday, took out all the obvious stops, turns on I was going to nearly say a tikkie, which is a South African coin, okay? turned on a ticky. Stops are key. And we calculate a stop loss for every share every single day, which is well out of the traffic. It's doing its best to allow the share to move up, but at the same time protect your capital. Stop loss placement is key to your survival. This does it automatically based on a concept called, technicians will understand, called average true range, okay, which looks at volatility. We put a buy, sell, or hold to every share in the market every single day, and that can certainly be used to enter. For a worry-free strategy, I want the share to either be on a buy or a hold. If it's below its stop loss, I'm not interested. So I'm looking for a share with a relative value in earnings, a share price appreciation potential of greater than 1.25 above a corporate bond. I want it to be the safest on the London stock market with a relative safety above 1.3. And I want the darn thing to be on a buy or a hold. And I want it to have sufficient liquidity for me to be able to get in and out. Getting into a stock and out of a stock is a bit like marriage. Hell of a easy to get in, bloody difficult to get out. Those of you that have experienced it. If it wasn't for Bob Marley, I would have never got through my divorce, okay? Very, very difficult to get out. I keep humming, don't worry about a thing, okay? That's the stock that I'm talking about. It's called Cape Tech. And Cape Tech has got a great mixture of both earnings growth and earnings safety. And if that darn thing doesn't go up from 4 till about 6 soon, I'll eat every book on analysis that I've got. But I'm only right 80% of the time. That means I'm wrong 20% of the time. On the next trade, you don't know whether it's one of the 8 or one of the 2. That's the reality of the situation that we all get our wee minds around, and it's darn difficult. It's called thinking in probabilities. But I'm reasonably sure. That's my standard layout, folks. The green line is the Vector S valuation. You see the little fine blue line? That's the Vector S stop loss out of the traffic, but close. And it follows the share up the page, and this blue line is earnings per share. Now, I'm going to quote Ben Graham again, sir. Earnings per share growth is the engine that drives the share price. I've got in my little office, the office is still in Johannesburg, but I've got a little office, and I've got that on the wall. Earnings per share growth is the engine that drives the share price. And I don't care how many algos are out there in the city. If a share makes more money next year than it does this year, the darn thing is going to be worth more next year than it is this year. Earnings per share growth is absolute key. And even more so if you venture across the pond to America. One little blips on earnings and those American shares go down. They don't go down da-da-da-da-da. They go boof. So a more controversial thing now is market timing. And our mantra is buying rising stocks and rising markets. And of course, on another seminar, you could short sell falling stocks and falling markets. I firmly believe, folks, that if you get nothing away from this talk or today, the most important thing to know is whether the overall market is rising or falling. Everything follows from that. If the general market is rising, easy to make money. If the general market is falling, really difficult to make money. So at Vector Vest, we believe being very aggressive when the general market is rising and being very conservative when the general market is falling. As I said earlier, if the general market is falling, don't buy anything more. Sit. Doing nothing is much more difficult than it would seem. Okay? Watch your stop losses carefully. 3, sell your laggards. Build a bit of cash for the next buy signal. Selling's not easy. When you bought into the share, it was all full of enthusiasm and getting out that parting is not easy, but it has to be done. Easy to ignore market direction. And that's my metaphor. I showed that metaphor earlier. I haven't been on one of these things in 40 years, but the last time I was on one, they take forever to get up there and they fall very quickly. Who's been on one more recently than 40 years? What do you think? Are they still the same, sir? Oh, dear. I would toss my hair. All right. So there has been some innovations, the young man at the back says, in the last 40 years. But they still take a heck of a long time to get up, and they fall very quickly. The front page of VectorVest is laid out so that you can see what's happening in the general market in one glance. I'm more than happy to admit that there's an awful lot of information on it. Now, VectorVest has got two quite sexy apps that fit the phone, the Google Android phone, and the iPhone, and so that you can see what's happening in the market at a glance. So I don't care how busy you are, you can tell whether the market is rising or falling at a glance. And let's face it, we spend half our blessed days with our head in the phone, so there's no excuse for not knowing whether the market is rising or falling. If the market is rising, there's going to be very little to do. If the market is falling, then you have to be careful. You don't know, is this fall just a little bit of a seasonal pullback, or have we got a 2008 on our hands? That Everguard scared the living daylights out of me the other week. You remember that? They owe billions, and they couldn't come up with 26 miserable million to pay the bondholders. 26 million they couldn't come up with. So that's not over, by the way, I don't think. This is the chart of the VectorVest composite of the UK. It's an equally weighted index of all of the shares that we follow on the London stock market and on AIM. It's the broadest measure of the London market that I personally know of. Can you see the red and the green triangles on that? Yeah? Okay, those are our longest term market timing system. If I had more time, and I haven't, James is telling me I have no more time, I could tell you exactly how it's generated. The signals are generated mechanically. They look at the price of the VectorVest composite, they look at the momentum of the VectorVest composite, and they look at the breadth of the VectorVest composite. So we're looking at three things. We have 5 market timing systems. A short-term system for scalpers, spread bettors over a couple of days, a medium-term system that I talked about this morning in our swing trading seminar, and this longer-term methodology for position traders. And these signals are the signals that we use for our worry-free investing. And as you can see, that's the buy-in last March, April. We had a little bit of a sell-off a year ago in November, and then you can see the green. The green, that was the Pfizer vaccine. Okay, turned it on a sixpence. It moved up again. We had a little bit of a pullback in August, and the biggest pullback that we've had since COVID occurred in September, October, and last Friday night, a week now, the market has been moving up again. And I am now, I got out of my laggards in this last little bit, and I announced that all on a Monday afternoon, all in the public domain. And I've been buying in again, and I'm hopefully will be fully invested. I think if I hadn't been here today and preparing for here yesterday, I would be fully invested by now. So when the market is rising, I don't know what's going to happen next. Nobody knows what's going to happen next apart from the big fella up there. And I don't think he trades. At least I hope I'm not taking the other side of his positions. And please excuse the chauvinistic content. Maybe God is, if God is a lady, I think it has to be Dame Judi Dench. Okay. nobody knows what's going to happen next. Nobody. And getting yourself to a point where you can make good decisions when you haven't got all the facts is quite something. Trading and investing is much more like poker than it is chess. In chess, everything is known. In poker, the best player in the world can lose to the worst player in the world if the worst player in the world gets a good hand. There's unknowns always. So nobody knows what's going to happen next, but I'm in. So how do we do this? Well, Unisearch will find these stocks for us automatically by building a watch list of what we want. And I'm trying to find the UK's safest stocks that are growing earnings strongly. Very special animals. Okay? And I'm going to prioritize the safety and predictability of the earnings stream ahead of growth. I want reasonable growth, but I want very, very safe stocks because I want to be able to leave them without stressing. Now, if I was managing your money, folks, and if it wasn't for the damn compliance, I would start my own asset management company, but I'm too old for the compliance. It's just hell. I would put 80% of it into worry-free stocks, and 20% I would do some swing trading. And that's a good ratio. I've tested this until I'm blue in the face. I haven't done any testing since 2016, but I am testing it going forward with real money. I'm too old for any more testing. The key is relative safety. I want that relative safety to be above 1.25, and I want earnings to be strong with that RV of greater than 1.25. And that's the makeup of relative safety. And that's a very simple little search. I want the stock to be above 50 pence. It's not a trading search, so I've got a liquidity of 50,000 shares. I think that if you are starting this with a big portfolio, you would want to push that up a little bit. I'm not looking at AIM for the time being, but AIM, there's some really great stocks on AIM, but on this search, I'm not looking at AIM, and this is a standard search on VectorVest. I want the relative value to be above 1.25, and that little double arrow means not on a sell. And I'm sorting them by relative safety, the safest stocks to the top of the pile. Now, I'm using my confirm call signals, those green triangles, to tell me when it's safe. And that's where we are. When there's a confirmed up, I want to be fully invested. When there's a confirmed down, no buying anymore, watch my stop losses carefully. If I get stopped out, build a cash position. When we get the next confirmed up, back to fully invested again. And on our stand, we have a little brochure of the rules of the system that you can pick up outside. Now, I tested this from the bottom. That's from the first signal after COVID. And most of these positions I still have running. And since the COVID lows, this portfolio is up 63% and the market's up 36%. There was one bad one, Avon. Avon let us down. There's always a bad one. Avon dropped the ball. They make face masks for the American military, and they stuffed up the face masks. So they dropped the ball, and we looked at the share earlier, and they've still dropped the ball. It doesn't look as if it wants to turn soon, although it's looking more interesting than it did. And that's the performance. That's 43% annualized, and all of those shares paid a dividend. And that's just sitting, doing nothing, no trading whatsoever in the last 18 months. So this mixture of growth and safety, I've proven over the last 20 years, works exceptionally well. And your most difficult thing is to do nothing. And as I said 1,000 times now, doing nothing is much more difficult than it would seem. You always want to tinker with it. At least I do. At least I do. Now that's since last November, folks. And since last November, which is pretty much a year now, it's produced a 24% plus dividends, and that's the scorecard. Market's up annualized 16. This is up annualized 26. So nobody's saying you're going to get rich in a fortnight, but you can get rich slowly. And remember, if I told people that I was making 26% for them as an asset manager, they wouldn't believe me. So one of the things that you do as an asset manager is that you bring the returns down and keep a little bit of cash on one side in case you have a bad year. Okay, nobody believes you. So that's what it's done. And that was in 2019. Market was up 2019, it was up 14%. We were up 48%. We were up 48% going into COVID. I got stopped out of everything in the COVID collapse, everything. And I gave 15% of that back. So from the start of 2019 into February 2020, I was up about 33%. I gave 15% back in the COVID collapse. Everything got stopped out. That's the first time that I've been stopped out of everything since 2008. Okay? If you had not have got stopped out, all of the shares have in fact gone back up again. But I stick to the rules of the system, which is when they close below the vector-based stop loss, I just simply get out. In the US, this can be mechanized, and vector-based can talk to your broker. But in the UK, the regulator says that that would be financial advice. So there has to be a mechanical. So the computer can email you when it's time to get out, will email you when it's time to get out. But the regulator says there has to be a mechanical step. You've got to make that decision for yourself. Otherwise, it would be one-on-one written financial advice, which we are not licensed to do. So that's what it's done over the last year. That's the equity curve in 2019. In 2019, there was 2 trades the whole year. In August 2019, and we turned £50,000 into £72,000, which is that 44% increase. And that's excluding dividends. Most of those shares paid 3-4% dividend yield. And then, of course, I gave back 15% of that in COVID, as the market fell in COVID. So, and that's the 3-year performance. 1 month, it's down, and this was done just at the end of that sell-off that we had. 3 months, 4.66. 6 months, up 12%, and 3 years, up 111% over 3 years. So the edge is finding the UK's safest shares that have got a proven ability to grow earnings strongly and manage them well. We want to be strong and brave when the general market is rising, and we want to be very timid and scared when the general market is falling. I tested this for 20 years. I haven't done any testing since 2016. Back testing. I've been testing it going forward with my own money. And that's what happened in that 20 years. This is in the US. That's a 17% compounded rate of return. The S&P in those years did 7.5%. Not easy. There's the bear market, 2000 to 2003. That's the global financial crisis where we went totally into cash here. And that's what it's done. And clearly now it's gone up, but that's since 2016. And if you want to put this together, we have a great offer for you. If you go to the website, VectorVest gives a 30-day trial for a $5, but we've been doing business with James and Lisa Campbell for a long time, and today we're offering a 60-day trial for £5.95. If you like it, then it's invoiced at £49 a month on a month-by-month basis. If you don't like it, stop it. We shall remain friends. Okay, so our objective is to find the UK's safest shares that at the same time are growing earnings strongly when the general market is rising. When the general market is rising, there's very little to do apart from buying the shares and sitting. When the general market is falling, you're much more likely to get stopped out. If we have a pullback like the COVID pullback or the 2008 pullback, I don't care what the fundamentals are like, every darn thing falls. In a normal pullback, like the pullback that we had last November, like the pullback that we had in July, none of my shares got stopped out at all. The high RS shares are quite robust, but in a crack of market sentiment, everything falls. So when the general market is falling, then you need to be on your toes, okay? And a quick glance at your telephone every morning will give you the most important information. Is the market rising? Is the market falling? If the market is rising, nothing to do. If you get some more cash, if your granny dies and leaves you £250,000, then if the market is rising, you can add to your portfolio. If the market is falling and your granny gives you £250,000 on her will, then just let it sit in the bank until the market turns back up again. Use your loaf. Okay? The most important thing to know is whether the market is rising or falling. I firmly believe, and I dogmatically tell everybody every Monday afternoon, that 70% of the exercise is knowing whether the market is rising or falling. Everything follows from that. We don't trade markets, ladies and gentlemen. We trade our beliefs about markets, and that's my belief about markets. I started to trade in 1982 while I was working for De Beers in South Africa. And in April 1988, I resigned from De Beers. My dear mother had a heart attack, and I started to trade full-time. Now, once you haven't got the luxury of a salary check coming in, it's quite a shock. So I sat down in April 1988, and I went through every bit of my trading for the last 5 or 6 years. And I showed categorically, and this was quite a revelation at the time, I showed that when I was making money easily, the general market was rising, and when I struggled to make money, the general market was falling. That was quite a revelation to me at the time. I hadn't worked that out in my little mind. If you ever get around to reading a book called How I Made $2 Million in the Stock Market by a guy called Nicholas Darvas, you'll see that he worked through exactly the same process in the 1950s. It's a really good book, that. It sounds like a crummy title, but it's a really, really good book by Nicholas Darvas, How I Made $2 Million in the Stock Market. Well, it's a simple little book. You'll read it in half an hour, but well worth the read. So, folks, in terms of support, I do a webcast every Monday afternoon where I show everybody what I'm doing. We have a national user group once a month, which Susan Thornborough, who runs our London group, runs. We have an international user group that meets once a month, run by VectorVest man in Canada, Stan Heller, and I talk at that as well. We have a Thursday session called Trending Thursday. And with your trial, you'll get an 0800 number, and that gets you through to our call center. It's in North Carolina. It's a free call, and the call center is open from 12 o'clock midday to 12 o'clock at night. And if you have a problem with your account, if you have a problem with interpretation of the program, if you have a problem working out what to do, they will do their best to give you some advice. So the first level of support is over the telephone. So, folks, I hope you enjoyed the talk. There's not much to it. Try and find the UK's safest shares, and VectorVest will do that for you automatically. I'll be on the stand for the rest of the day, and I look forward to chatting with you. Thanks very much indeed.